You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth.
Hello, I'm Deidre Woollard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. We're diving into rental properties again. It's one of our favorite topics, but this time we're going to take it from a little bit of a different perspective and talk about syndication. Today, my guest is Lane Kawaoka. Lane is a former civil and industrial engineer, and his investing career began with single-family rentals around the United States. He now invests in syndication deals, including Class C and B multifamily, RV parks, mobile homes, assisted living, really kind of runs the spectrum. And he shares our passion for making real estate investing really understandable and accessible for everyone. So thank you for joining me today.
Yeah, thanks for having me.
So tell me a little bit about your journey, because I believe were you in Seattle when you were an engineer and now you're living the dream in Hawaii?
Yeah. So I kind of walked this linear path, is what I call it. I was told to go to school, study hard. For some reason, I was good at math and science when I was 9 or 10, so I became an engineer in college. My parents kind of pushed me in this: go to school, study hard, work at a job for 40, 50 years, and then buy a house along the way. A lot of this mainstream financial advice, right, which I don't necessarily agree with for some people. But I bought a house to live in because I got paid a good professional salary, saved my money up. But I was, working on the road all the time, as a lot of young professionals do. So I just started to rent out that house that I bought because I was only there on Saturdays. And, and it was in Seattle, $2,200 a month for rent. The mortgage PITI was $1,600, and to a young 20-something-year-old kid, that was a lot of beer money. But then I got to thinking, and I was like, wow, if I just keep doing this, I'll be out of the rat race, be able to fire my boss and do whatever I want. So that was kind of the start of it all.
I was looking at your bio. It said that you had 11 single family properties, and somewhere along the way, you kind of made that leap from having a bunch of rentals, and it seemed like they were kind of all over the place, to syndication. What was that process like?
Yeah, so I bought those first few properties in Seattle, and then I realized sophisticated cash flow investors don't buy in primary markets like California, Hawaii, New York. They buy in these more secondary, tertiary markets like Birmingham, Atlanta, Indianapolis, Kansas City, Memphis, Little Rock. So these are the places you're going to find rent to value ratios higher than 1%. So you take the monthly rent divided by the purchase price, and you're looking for something 1% or higher to be able to cash flow, to be kind of insulated from prices going up and down. And at the end of the day, the end goal is streams of income. So that's what I tried to do. I still working my professional job, pretty frugal guy. I was able to save 50 to 100 grand a year to go buy properties. So around 2015, I had 11 of these rentals, 5 in Atlanta, 4 in Birmingham, 1 in Indianapolis, and one little one in Newcastle, Pennsylvania. But then I realized, as I started to pay for different mastermind groups, get around other accredited high net worth investors, other doctors, lawyers, engineers, but 10, 20 years further along the path of myself, that, rental property is a great way to get started. But most accredited investors graduate to these private placements and syndications. And some people refer to these as the country club deals, right? A group of investors will get together and pool together their money so they can go after a better asset, a better deal. A lot of these deals are out of the reach of mom and pop investors that just bid up properties. And then also below the institutional players, buying those 400, 500 unit apartment complexes, the A-class type of stuff. So there's kind of a void between, above $2 million, below $10 to $20 million is where this private equity space of private placements and syndications. And, so I had my 11 rentals, and on those 11 rentals, I had an eviction or two every year, some kind of big catastrophe every quarter. Those would be like a tree falling on my house, or some kind of tenant move out, or I've had a few times where I've had to pay $5,000 to $20,000 on a tenant move over because the tenant just trashed the place, which is very disheartening. But 10 rentals, each rental you get maybe a few $100 of cash flow. 10 rentals is $3,000 a month, which is, hey, I'm not complaining, right? Like when I started out back in 2009, that was the dream to me. But I don't know what American family can survive off $3,000 passive a month. Most of us have that goal of $10,000 a month to get up to that ledge. And now you're looking at 30 rentals. And so 3 times all those numbers. So now that's an eviction every other month, some kind of big catastrophe every few weeks. As you can see, it's not very scalable.
That is a really good point. I wanted to circle back to something that you mentioned that I think is pretty interesting, which is you were saving a lot of money to put towards your real estate investments. I think a lot of people wonder how you could do something like that. What were your tips for sort of being really frugal as you started off early on?
I was just born pretty frugal, right? Like that's just how we were brought up. You don't go to a restaurant and buy a soft drink. I didn't know that we were allowed to do that until went to college and went out on my own. I just was really good at saving money, and there's definitely a minority of people out there like myself that max out our 401ks, do all of that. But there's kind of two camps in the personal finance blog sphere. You have the frugal camp, right? The lean fire, right? Don't get your latte. It'll turn into $50,000 in 30 years, right? And then there's people like kind of in my camp, right, where you go into good debt to acquire assets. You loosen the belt if you're investing in the right things, right? If you're fully leveraging yourself into good deals and good assets. Um, but everybody kind of starts out, and when I graduated college, I didn't have any money, so I just kind of started from zero. Luckily, I didn't have too much student debt, but I was able to save, at least $40,000-$50,000 out of my salary. And I didn't get paid six figures out the gate. This is back in 2009. I mean, civil engineers don't get paid that much money, but I was able to save a lot of it because, like I said, when I started to buy that first rental property, and started to rent it out, I moved out of it. And people are like, well, where did you live? And I'm like, well, I just lived off the company dollar for 3 years. They put me in hotels, so I just did that, right? So I'm a big fan of, like, people, sucking it up for a little bit so you can live like how people dream.
Well, yeah, and sometimes when you're working toward that goal, you have to kind of build the sacrifice in. It's like working out or anything else that you have to sort of anticipate that there might be a little pain in if you want the big rewards.
Right.
I was wondering too, you mentioned good debt, and I was looking at your bio, and I know you had some bad luck with one of your first syndications, and I kind of wanted to dive into that. Tell us what happened and really what it taught you.
Yeah, so these syndication deals, typically they're way better than buying a rental property, especially if you're buying one of these turnkey rentals. That's kind of, you're paying a retail price for. Yeah, it's a good cash flowing stream property, and the property will tend to appreciate over time. But syndication deals have forced appreciation. We're going in, we're changing out the flooring, new appliances, giving the property a facelift, increasing the operating income, which in terms force appreciates the asset and increases the price, the value of the property. Um, I mean, that's kind of like the big difference between syndication deals and just people doing it on their own. And it's a much more scalable asset. But the problem with syndication deals is, you're relying on the operator, right? So you really have to work with honest and truthful people that have good business sense and are competent. It's not hard to find these people. Really, it isn't. But there are landmines out there, make no mistake. So for a new rental somebody who's never owned a rental property, I mean, you're looking at a pitch deck. Everybody has a podcast these days. Everybody can create a webinar. I mean, everybody looks solid, right? I mean, it's real estate, it's marketing, right? It's just like real estate agents, navy pants and brown shoes, right? Everybody's got the uniform down pat. But how do you figure out who's legit and who's just an internet marketer, right? Well, I mean, you have to build up your network, right, of other pure passive accredited investors and get around other people. I didn't have that when I first started. My parents didn't even own rental property. I didn't know too many people over $1 million net worth. I didn't know anybody really investing in this stuff. But I jumped into the game, and I eventually, kind of stayed in the ethos, and it expanded my network. The podcast that I do today really helps attract those types of people to me. So that's my competitive advantage. But it's going to take most people a few years to build up a Rolodex of pure passive investors to then disseminate who do I want to place money with.
And so, in one of those first deals, did you end up losing money because you put your faith in the wrong person?
Pretty much, yeah. I actually found out the guy was kind of a shyster 3 months later. And I was like, oh, well, I hope he doesn't take my money. But yeah, he ended up did 2 years later. I found out they kind of sent out the letter saying, yeah, we were going bankrupt. And it's like, well, lesson learned, right? I didn't fight it. I didn't, most people will get a lawyer and then burn up $20,000 of legal fees, I mean, but that's why you diversify, right? Like, I don't advocate any of my investors to put in more than 5 or 10% of their net worth into any one deal, because you want to be diversified over different partners, different asset classes, and geographic areas. Now, this is what accredited investors do. They don't take chances.
How important do you think ethics are in real estate investing as a whole, especially when you're dealing with these kinds of large sums?
It's kind of funny. Like, we'll go to the bank and just wearing regular clothes, and we've got like $9 million of investor capital there. It's kind of crazy. The bank teller kind of just looks at us like we're kind of crazy. You could do a lot of bad with that, right? And people have. The way I look at it, most people are good, and they want to create sustainable businesses where happy customers come back. I mean, most investors diversify, like I said, right? They're maybe putting in $50,000 of their $1 or $2 million net worth. You know, us, we'd like to get at the whole lot, right? Eventually. And how do you do that? Well, you make people happy, right? You give them consistent returns, and you do what you say you're going to do, and don't take people's money. Things are going to go good and bad within the deal, but at least the sponsors are acting responsibly with fiduciary responsibility. And that's what, in a syndication, I mean, there's a lot of documents in there, but essentially the sponsor is signing up for fiduciary responsibility to do what's the best interest of the passive investors.
So let's talk a little bit about that due diligence, because that's one of the things for both syndication and crowdfunding. You're looking at this massive pile of documents. If you're not someone who really understands what they're doing, especially if it's a ground up development, that can be really complicated. What does your due diligence look like?
Yeah, so there's a lot of documents, right? A private placement memorandum can be 100, 150 pages. Every other paragraph is capital letters saying that there could be aliens or pandemics coming down or floods. But it does two things, right? It signs the sponsor up for fiduciary responsibility, do not lie, cheat, steal, act in the best interest of LPs. But it also signs the passive investors up to say, yeah, we understand that there is risk involved with this. Because there are some passive investors out there, which is why we kind of vet the right people, that if they're not happy, or even if they get the returns they're looking for, they'll sue. That's just how things are out there. And that's why this document, the private placement memorandum, kind of sets the rules of engagement to keep things fair for both sides, right? But like I said, you can all have all the great paperwork and all the legal documents in order, but if your sponsors are dishonest, the paper means nothing at the end of the day. But true due diligence from a passive investor's perspective is kind of twofold. First, the people component, and then the numbers, right? So people is track record. Do you know anybody personally that you trust that doesn't have a dog in the fight, that's not going to get any referral fee, or, you know, actually has put 50 grand with this person, or substantial amount of money, and got in a good something happen. I've seen a lot of people say, oh yeah, Andrew's really good, right? But when you come to find out, they didn't even invest with the guy. So how do they know how many Facebook likes the guy has, right? That's the gold standard of investing via proxy. Like, somebody personally, and they've actually invested money with the person. But like I said, when you're starting out, likely you're not going to have that, right? So you're going to have to kind of go off of, just kind of loose referrals at first. But yeah, you're trying to verify character, track record, competence. Next is the numbers, right? Most passive investors don't know how to underwrite deals, right? Even if we gave investors the profit and loss statements, the rent rolls, I'll be honest, 95% of them won't even know what to do with them. It'll just confuse them, and they just won't invest. And which is why in most pitch decks, you don't have that in there, right? You have things like, what were the sales comps, which to me, as a sophisticated investor, I don't really look at that, because you don't know what the story is of all those comparables, right? So it's useless to me, but it's put in there, right? So there's a lot of red herrings in a pitch deck, that you as a passive investor just are constantly bombarded with, and you have to make the right decision. Unfortunately, like I said, most passive investors do not have the knowledge to underwrite deals themselves, so they have to rely on the first one, which is the people, right? But like I said, once you find the right people you work with with good success, stick to them.
Really good point. And I think it also brings up something else is you're using the term passive investing. And that's one of the things that I believe is that passive investing isn't really ever truly passive because you are responsible for doing your own due diligence. You are responsible for keeping track of the project, and especially because syndications and these deals take a lot of time sometimes. I mean, you don't really get your returns back for 3-4 years, depending on, or even longer, depending on what's going on. Do you think that there's a little bit that passive investing is a misnomer, and that it can suck people into thinking like, oh, I just hand over a check and then money comes back to me magically?
I mean, it's certainly easier than like a turnkey rental, right? That term where I mean that is semi-active for sure. But I'm big into like the minimum effective dose, right? And what is the very least that a passive investor can do, and where can they focus their very sparse time and focus and energy into doing due diligence the right way, right? Most passive investors or accredited investors are busy people, and these guys have families, right? To me, if you're spending more than a few hours a month being a passive investor, you're just spending too long. You're just looking at the wrong things. You're just going down a lot of rabbit holes. Again, I would focus on building relationships with passive investors to help kind of co-source your due diligence for you. But really, like, what are you looking at? Like I said, like in the pitch deck, there's not much that really tells you if it's a good deal in there, right? And I say, like, that's why I'm emphasizing build your network, build your network. Your network is your net worth eventually. But yeah, like once a lot of this is predicated on the load, right? You're doing a due diligence, wiring over your funds, and that's it. You're hands off. You've made your decision. You're already on the boat. You're already on the plane. The plane has taken off, right? And now let that whatever happens in that little mini experiment dictate on what you do in the future, right? Most passive syndication investors that are accredited eventually get into a few dozen investments, right? I don't know. I guess there's always a handful of guys, the propeller hat guys, who like read every little P&L that gets sent out with the quarterly financials. But it's just and that's not in the scope of a passive investor, in my opinion. And there are more better ways you can be using your time.
So, in terms of syndication and setting things up as a limited partner, how do you do that in general? Do you build a separate LLC for each deal, or is it something that you do from different accounts? I think that's something that beginning investors are often concerned about. How do they get started?
Yeah, so on the partnership level, like, we're the sponsor, so we set up a LLC or a LP to encapsulate the asset and the deal, right? So you're going to have that protection right there. But, I'm giving the disclaimer now. I'm not a lawyer, right? But I'm just telling you from my experience of having over 400, 500 investors that normally I would say most people, the vast majority, just invest through their personal name, right? I'm also the same guy. If you own a rental property, you probably should have an LLC because there's a heck of a lot more liability in owning a rental property than a passive LP position. And let's talk about it. Like there is some risk there, but it's essentially zero because you're not a managing member, you're not making calls, and you're a passive LP investor. There's very little liability in there. If anything, the liability is with you, maybe going out, driving and hitting grandma, and then them coming after your assets. At that point, it would be good for you to put assets in the LLC to protect it from you. But most investors just start out, if you're investing less than $500,000, start out maybe in your personal name. But as you start to grow your holdings, maybe start to silo them in different types of things. Maybe $500,000 per LLC. But of course, everything's different, right? I'm not giving any legal advice here, but I'm just telling you what I see. And whatever you do, definitely do not commingle the LP holdings with active businesses or rental properties, because those are more lightning rods for liability, and you don't want to commingle these lower risk holdings with those.
Yeah, that can be a tax mess as well. All right, so this is a great place to take a short break.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
During our break today, we are excited to have Millionacres lead investment analyst Matt Argersinger here to speak briefly about one of our newest services, Real Estate Winners. Thank you for joining us, Matt.
Thanks for having me.
So what is Real Estate Winners and who is it for?
Well, I like to think of Real Estate Winners as our answer to Stock Advisor in the real estate market. It is a service that provides recommendations on publicly traded real estate investment trusts and real estate companies. So it's a pretty big universe out there. There's over 200 REITs to choose from, and probably dozens, if not hundreds, of real estate companies are in our universe. And we provide regular investment recommendations as well as commentary on the market, educational material. And it's really designed to get anyone who's interested in investing and learning about real estate started.
So is it geared toward new investors or is it more for seasoned pros?
I think Real Estate Winners can serve both. I think if you're a new investor, maybe you're just getting started with stocks and you want to learn more about how to add real estate to your portfolio, great place to start. If you're a seasoned investor and just thinking, okay, how can I diversify my portfolio, maybe reduce the volatility in my portfolio, maybe add some income to my portfolio, then I think Real Estate Winners is a great solution for that cohort as well.
Fantastic. What are the benefits of being a member of Real Estate Winners?
Number one benefit is day one when you join, you get our top 10 investment ideas at the moment. So really right from the beginning, you know what our 10 best ideas in the publicly traded real estate market are. And then going forward on a monthly basis, you'll get a new recommendation, sometimes more than one new recommendation, as well as regular content that we're coming out. We're covering our past recommendations, providing updates, and talking about the real estate market. So it's really the full package.
Perfect. So what do you need to get started?
Really all you need is a discount brokerage account. So if you're used to buying stocks, and you probably already have that. If you haven't bought stocks in the past, of course, just open a discount brokerage account. These days, you don't even have to pay commissions. It's fantastic. So it really couldn't be easier to get started investing with Real Estate Winners.
Sounds fantastic. So how can people sign up?
Sure. They can head over to real.fool.com. That's real.fool.com.
Great. Thank you so much, Matt. I'm back with Lane Kawaoka, and we're talking about investing in real estate syndication. So your path was you started with single family homes and then you went to syndication. Do you believe that everyone should do that because there's lessons that you learn, or do you think it's possible to leapfrog directly into syndication if you're already an accredited investor and you have that net worth?
Yeah, if you're an accredited investor, you probably could leapfrog this stuff and go straight to the MBA, as they say. But there's a couple of reasons why I like to see people having rental properties. Especially as a sponsor, right? Because when I know people have rental properties, they understand that you don't always make money every month, right? Things happen, and I like to have nice investors who understand this, right? And don't have unreasonable expectations, right? But for the passive investor listing right now, right? Like by owning rental properties, you understand certain things heuristically. Like you may already understand academically, like the rent to value ratio, which you referred to earlier. You're looking for something 1% or higher so that you're able to cash flow on a monthly basis, right? People, if you've never owned rental property, you may academically nod your head, shake your head. Yeah, I get it. Simple, right? It is simple. But people who have actually owned rental property before understand, right, in their heart, oh man, that HVAC went out. That's $3,000 I had to pay, right? Now I know what that CapEx item Lane was talking about was for, right? And then secondly, I think this is the big thing. Like when you're a syndication accredited investor, the name of the game is building your network of other pure passive investors. Everybody's rich, right? You have to add some value to other people. And if you've never owned rental property, it's hard to get into a good rapport and conversation with another sophisticated accredited investor, right? You don't have war stories, right? You're not in the cool kids club. You've never owned rental properties before. Now, I'm not saying it's like impossible to kind of transition right to syndications, but I would say, I try not to use rules, but if your net worth is under $250,000, for sure, start off with single family homes. You have no business being in syndications, right? Because at $50,000 a piece, you're probably going to be pushing 20% of your net worth, and that's just too much for you. Um, People will let you in, though. I mean, there are desperate people looking for money that would love to take in 25 grand from anybody. I would really caution about going into those deals in the first place. But yeah, general rule, 250,000 or less. Look, you got to build up your track record. And I mean, that's what I did from 2009 to 2015. It took me almost a decade to get my net worth to be 700,000. And that's just how it is. That's life, right? This is not a get rich quick thing, but it's a get rich surely thing.
I love that because I think that you and I have both seen real estate investing gurus out there who are trying to do that get rich quick thing. And anyone who's been in real estate investing knows it's not get rich quick. It's get rich over time. And having those war stories, certainly on our team on Million Acres, we've got a bunch of landlords. We definitely have some war stories on our crew. So I wanted to ask you about how you evaluate deals because at Million Acres we have this premium service called Mogul that I mentioned before, and our analysts are looking at the crowdfunded deals that are on a lot of the popular platforms, and there are a lot of them coming through. There's a lot of work. Are you also looking at that high volume of deals, and have you developed a process to kind of get through that a little faster?
I'm able to cheat a little bit these days. I only look at the cream of the crop, and I can usually outsource it to our lenders to do the initial running for us, the numbers running. But so I used to. I mean, that's where you start off. That's how you learn how to underwrite deals, right? Going through, I think my first 6 months doing this stuff in apartments, I underwrote maybe 100 deals that takes 15-20 minutes, especially in the beginning, because you got to get the P&Ls. There's always inconsistency in the P&Ls. You have to take the rent rolls, and you're always kind of looking for inconsistencies. Like, did they just throw people in the last second, right? And you're ultimately trying to put it into your model. Everybody's model is a little bit different. What is a model? It's essentially a complicated spreadsheet, right? That you put in the profit and loss statements, like the T12, the T3, right? And you throw in your assumptions, right? And when I kind of teach my guys how to analyze deals, it's not how to put this into the spreadsheet. That's kind of at more advanced level. But what are the assumptions that you're looking at to make sure that double check the sponsor is using responsible assumptions? So the top three are like reversion cap rate. What are they assuming that the market is trading these assets for in the next 3 to 5 years, right? The next one is rent increases per year, right? I don't want to see the sponsor, assuming the rents are going to go up 2.5% every year. I want to see 2% or less, right? I want it to be conservative. And then, the last one is like, what is the full occupancy or are they assuming for economic vacancy in there, right? Those are the big things that drive the numbers and that ultimately the number at the bottom of the spreadsheet. 100% return in 5 years can quickly turn into 40% return in 5 years if you're using the wrong assumptions. So that's kind of the due diligence that I personally do. And I just run it myself, right? Like, I don't trust the syndicator. I'm just going to run it myself and see what the number I get at the bottom of the spreadsheet. So I'm able to cheat, right? Like, I'm able to run the numbers, and if I can pretty much tell if the sponsor is using what assumptions. And if they're kind of being a little overzealous, I just won't even interact with the guy, right? And I move on, right? But most passive investors aren't able to do this. So they're going to have to rely on their network.
Good point. I do feel that sometimes you see sponsors being a little too optimistic about rent increases and things like that. But you mentioned a term that I want to go back to because I don't think a lot of people understand it, and that's economic vacancy. Because I think people don't understand that there's a difference between physical vacancy and an economic vacancy. Can you explain that?
Yeah. So physical vacancy is like, let's say we have a 100-unit property. 10% of the units, 10 units are not filled with people, right? Well, then you have a 90% physical occupancy. But, oh, by the way, we didn't tell you, but 10 of those people that are in there of the 90 are deadbeats not paying. So now we have an 80% economic vacancy. So on the pitch deck, I might say we're 95% occupied. Well, when you look through the financials and you look at the bank statements, well, these 20 people that came at the end are just like warm bodies and they're not paying, right? And it doesn't happen very often, but there's always some element to it to some degree. And the sponsor needs to understand like that this needs to be accounted for. Like normally, across my 4,200 rental property portfolio, usually run at like 97% collections, So normally the properties are around, low 90s to mid 90s occupancy, right? We don't want to run this thing 95 or higher, despite what people think, because if you're running at 90% or high, 95% or higher, your rents are too low, right? You need to bump up your rents so you hit that optimal set point, 92 to 95%. But even if you're running at 92 to 95% physical occupancy, you're going to not going to collect all your rents, which is defined as collections, or in this case, economic vacancy. So 97% is what we usually hit across our portfolio. So it's usually an economic vacancy of 3%, plus maybe a physical occupancy of 5%. And this isn't a good stabilized asset. More of a C-class property, you might run it a little bit higher, maybe 6 to 8% physical occupancy and 4% non-collections for economic vacancy. But it's kind of, I'm going down a rabbit hole here, right? And this is like a constant like cup and ball game, hiding the ball with syndicator and passive investor, right? Like if only this was easy, but it's not, right? And it's not easy, but it's kind of simple. But this, as you can see, why most investors will just like, I'm confused. I'm just going to go give my money to XYZ big company who's going to take a third of or half of my returns anyway. And that's frustrates me.
I can understand that. I think I'm guessing that's one of the reasons that you developed your own real estate investors club. And I think the investor clubs are a real resource for people. Tell me a little bit about yours and how it works.
Yeah, I mean, most investor clubs are like free and they attract, everybody coming in the front door. I did not find much value going to that when I was first starting out, right? When you go to a local RIA club, it's a bunch of guys who, let's face it, they don't have too much money, right? They hear real estate is a way to get rich quick. These are your wholesalers, your flippers. And we kind of didn't say it in the beginning, but I'm in the passive investing camp, right? I was able to save a lot of money and I had a good paying salary. And I think there's a big community like that. But they go to like the local RIA or they go to the free internet forums and it's just people, more active people. And it's very different stuff than what the passive investor is kind of doing. So it's kind of discouraging for the passive investor, right? You're trying to find your tribe, but there's so much noise out everywhere, right? And there's all these, you don't know who to trust, right? There's a lot of sharks in these kinds of like free forums and these free clubs. So I've kind of tried and sought out a closed circle. I call it like a little bat cave, right? Of pure passive investors where we can kind of let loose a little bit and build relationships with peers, like-minded peers in this group. And that's ultimately where you're going to find the best strategies for taxes, infinite banking. A lot of people get fixated on the deals, right? To me, the deals is a third of it. The deals allow you to get passive activity losses through cost segregations, but then that allows you to play with your taxes, right? The government creates the tax code to allow us who invest to pay little to no taxes. The passive activity losses offset passive income. But if you're able to employ a real estate professional status strategy, you're able to knock out your ordinary income. So for a lot of my doctor clients, they're able to bring their, get out of that $500,000, $600,000 tax bracket. Everybody's worried, up in arms, right? Biden's going to kill people over $400,000. Well, you have the ability to lower your AGI to what you want. When you get these passive losses and you start to employ the strategies of the wealthy, and a lot of the stuff, it's not that complicated. It's very simple, but it's very counterintuitive to what your parents taught you, right? Or what's being talked around at your workplace. Same thing with like infinite banking, is another tactic that we like to use to kind of shelter wealth, grow it tax-free, and more importantly, shield it from creditors and litigators.
Can you define that for me?
Yeah, so infinite banking is kind of like a marketing term, but essentially what it's using is whole life insurance, but very different from the whole life insurance that your long lost college buddy calls you up for lunch and tries to sell you. Life insurance, you can configure it different ways, right? So to make it for this infinite banking type of method, we decrease the amount of returns that we get from it, which people think we're crazy, right? Why would you ever want to do that? And we decrease it for the amount of death payout we get, which again, people think we're crazy. But why do we do that? So we optimize the amount of liquidity. So what we're doing is we're overfunding this life insurance policy only to be able to take it out via a loan to ourselves, which we're paying tax-free, and we're making money tax-free in there. So it's kind of this people like to kind of flush this out. And that's where that infinite concept, that term comes around, because it kind of just cycles through there and you kind of bank from yourself.
Interesting. So you've talked about a lot of different things. I'm wondering, you've gone on into you're not working as an engineer anymore. Is your current situation, how much time are you spending every day in your businesses?
I am very active in my business. I'm probably spending 12 to 15 hours a day, either running apartments or on my family office consulting side, working with clients on this types of stuff. I feel like it's pretty fun, a lot more fun than my engineering job, that's for sure.
So you're in Hawaii, and are you dealing with time zone and distance issues? Do you go and check on your deals, or do you do trips every so often, or how does that work for you?
Yeah, I mean, before COVID, I was probably popping up there every other month at least. Through COVID, it's a little bit different, obviously. But we pay third party professional property management to do the day to day, right? So as asset managers, I mean, it's just really up to us to manage our property managers, our foot soldiers, most effectively, right? I do have partners, and we tag team on operations, but this it's nicer when you can work with more professional property management and vendors, right? And this is what's, I guess it's probably no surprise to a lot of people, but as you kind of climb the ladder, you get to work with more professionals. It gets easier, right? Like this is a lot easier than working with my single family homes back in the day. The professionalism, their capabilities are so much better. Um, to be a mom and pop landlord is so difficult compared to be a passive investor, and even kind of what I do these days as the asset manager.
Do you ever invest in Hawaii on the islands themselves, or are you still mostly doing mainland investing?
I'm against investing in primary markets. I mean, for me, the biggest thing is cash flow, right? I mean, the website's called Simple Passive Cash Flow for a reason. If they don't cash flow, I'm not too interested. But I'll be honest, like I don't really need the cash flow anymore. So I definitely do see how why people invest in development deals and things like that. But as somebody, as a first generation wealth person, we have to build our wealth with holding on to the end of the pool railing, right? Or having cash flow to put food on the table for us, right? We don't have all this money to just go and hit a bunch of home runs. And if we strike out, we don't care, right? We need to have a high reliability, high hit rate or cash flow in our investments. But once people get up to a certain level, right, hit that critical mass point or the escape velocity, however you want to visualize it, right, now you start to go after higher risk deals with much more higher return, right? And that's, I think, where, more sexy projects, developments. Maybe I might buy something in Hawaii, but I don't know. It's like frugal people are always frugal, right? Even when they have money. I don't know if I'm ever going to go exclusively and start to buy things like that. But I mean, I rent here in Hawaii. To me, it makes no sense to buy. Um, Buying makes sense for most people though, because I feel like it's a forced savings account. But like I said, the people, myself and in my tribe, we're good with our money. Like we don't, if we have an extra $500 lying around, we don't go spend it. We put it to investments. So for those people who are like that, you know, I would urge not to buy a house to live in, especially if you live in a primary market and invest it. I mean, just do the numbers yourself. I mean, the numbers don't lie. It's going to grow your net worth so much faster and so much more safely too.
Well, that's a really good point too, because you're investing in Class B and C. One of the things that everyone's talking about these days is workforce housing, and how there just isn't enough of it pretty much anywhere in the United States. So there's really that growing demand that's not going anywhere anytime soon.
Yeah. I mean, look at the pandemic, right? The prices stayed absolutely the same. in this workforce housing sector. And if there's any if there's any kind of testing the business plan, what we just went through, that's it. And I'm a little worried that now other people invest in other asset classes are going to find safe haven in multifamily and kind of play in our world, which I'm sure will happen. But I also invest in other asset classes, right? Because sophisticated investors, they diversify, right? Majority of my stuff, 70-80% of my portfolio is in residential workforce housing. But that's not everything.
Well, I know that it said in your bio that you do mobile homes. And I noticed Blackstone now is getting into the mobile home business. And so there might be a lot of competition sort of as this market shifts.
Yeah. Mobile home parks is still within the workforce housing realm, right? But office space, I think when people hear that word, they probably should cringe, right? But that's you go after good deals that transcend the asset class. What's happening? I still probably won't do like a retail shopping center or strip mall, something like that, because I don't know. I'm not a big fan of that. But maybe now's the time to go in on a boutique hotel, right? If it's cash flowing. How much worse can it be, right? This is when you get the best prices on this stuff. This is how the wealthy, the people who think long-term think. This is not how the mom and pop investor thinks, who just goes after what's been performing the best the last 12 to 24 months.
Yeah, there's going to be a lot of hotel distressed assets from what we're seeing. So as we wrap up, just wanted to ask you, right now your business is looking pretty great, but what is the most challenging part that you kind of face on a day-to-day basis?
Kind of just spending less time doing it, right? Trying to create your business to get it all done in 8 hours or less, right? The things are going pretty well, and that's the hard part, right? As most people who are successful will say, right? Like, you got to get it while the getting's good. I feel like this is potentially like the NFL, it's the not for long league, right? We don't know if multifamily is going to be the hot commodity or become overcrowded, right? At some point. So while we have the broker relationships now and we're kind of at the top of the heap, we're going to try and capitalize on that now.
If you could have any real estate investor's career besides your own, is there anyone that you really admire out there?
I don't know. There's honestly not too many models that I have. There's a lot of internet gurus and teachers, but they don't operate they don't operate stuff, to be honest. They're just educators, right? And they're just internet figures. I guess as far as operators, a lot of these guys will swim upstream and go to create more institutional funds and stop working with the average doctor, lawyer, engineer, right? They'll go to easier money as they start to swim upstream. My vision was always to kind of work with cool people, to have a boutique syndication company and still kind of help people get out of the rat race with good splits, good fee structures, until probably maybe I'll get lazy and stop doing that. But yeah, most people, they'll go to the institutional people and cross over to the dark side where they're taking huge fees and splits and become more of an institutional operator on Wall Street.
Well, I like that you're not going to go over to the dark side yet.
I'm pretty young. There's a lot of time. I probably will at some point.
Well, thank you so much for your time today. Just a reminder to listeners, you can find out more about Lane and what he does at simplepassivecashflow.com. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Get more real estate investing news and advice from Millionacres on Instagram @Millionacres and on Twitter @Millionacres_co. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss that Millionacres or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.